Good Wednesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this mate, Dimitri Pokemonic. How you doing, D?
Good morning, Will. How are you?
You want to start with a disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for. There's the disclaimer.
Excellent.
And I'm going to share my screen as I'm doing that. If you guys are joining us for the first time, Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, data, analytics. If you have a question, type it into the live chat on YouTube. Will's watching it. He'll read it back to me. And to give you guys a couple minutes to type in those questions, we'll start out taking a look at the pre-market report, see if we could get insights, what's going on in the pre-market hours, and then we'll move on to the questions. So let's start with the pre-market report. These are stocks trading in a pre-market hours. Up top here, we have this calendar view. It allows you to go back into a historical date to see what happened in a pre-market on that particular date. Today, we're over here, December 27th. And so far in the pre-market hours, we see we got 524 stocks trading higher in the pre-market hours, 256 lower. As far as volume goes, we got 741 million shares trading on up volume versus 35 million on down volume. And if we convert that volume to dollar value, we have $1.9 billion worth of stock trading higher versus $318 million worth of stock trading lower. From that perspective, so far, it looks like we're lining up for a bullish bias in a pre-market, potentially at the open as well. Okay, so let's look at it from a couple more perspectives, and then we'll move on to questions. Coming down here, and now we have a list of stocks, list of symbols trading in the pre-market hours. We have our most active stocks, our biggest percentage gainers in the pre-market hours, biggest percentage decliners. We see 65 stocks made our percentage gainers list, biggest percentage gainers list, 21 on our biggest percentage decliners list. So that looks also like the activity in the pre-market is leaning more towards with bullish sentiment. Now, to make this list, we do put certain thresholds in that the trading has to hit for liquidity, price, volume, because things in a pre-market can be very illiquid. But we do see stocks in there that are small cap, leveraged ETFs, could be closed-end fund, it could be a preferred stock, any security listed on a major U.S. exchange. If it's trading in pre-market hours and meets those thresholds, it can make this list. So to narrow down to a small group of stocks, we could use the filters above here. If you have a watch list, you could filter by your watch list. I'm going to use this filter in ETF. Click on it, and now we get a drop-down menu with different ETFs to select from. Let's do the SPY, which is the S&P 500 ETF. When you select it, the list below gets filtered by stocks that are holdings in SPY. So here, one stock made our biggest percentage gainers list, one on our biggest percentage decliners. So that looks pretty much balanced and evened out. But overall, so far, looks like the trading in a pre-market hours is leaning towards the bullish side of things. So that's a couple minutes. If we have questions, I'll take them now.
Nothing's popped up, D, but I think SPY may be right off its all-time high. It's come all the way back.
Yeah. So SPY, I think it did. Probably making a new high over here in pre-market, maybe, or close to it. If we don't have questions, got to excuse me, I have a cold, so I'm like talking through my cold here. But if
They
we
sound great.
don't, oh, thank you. If we don't have questions, maybe I'll continue. On SPY, what we've been doing is setting up different strategies and running the option profit calculator on multi-leg strategies. And let me go here on the options chain, go to December 29th. And I think what we did was start looking at multi-leg strategies that involved more than 2 legs. You know, we did like 3 legs, 4 legs. I think we went a little bit further. We talked about multi-leg strategies with ratios. We also talked about multi-leg strategies that were with cross different expirations, like calendar spreads and diagonals. And the idea there is to run an option profit calculator and, learn about different multi-leg strategies because they have, certain objectives, certain targets, certain goals. And you want to know about them because if you do have, a certain outlook in a stock, certain objective, or certain risk exposure you want to gain, you're aware of the different strategies that and the risks and rewards and how to potentially, price them and manage them. So that's the idea behind, this exercise. And by putting them in an options profit calculator, we could kind of visualize what it would look like and, where does this, strategies have, at expiration, where is it profitable, where is it unprofitable, and what your risks are. So let's continue with that unless we get some kind of a specific question about a tool somebody wants to discuss. So let's do another strategy that is more than 2 legs. I'll stay within this expiration. Let's say December 29th. And let's do what's called a box spread. So box spread, it's 4 legs. You could think of it as a call spread and a put spread on the same strikes. Okay, so maybe that's the easiest way to think about it. So, for example, here, let's do a 470, 475, 470 call. Okay, so I'm buying the 470 call and I'm selling the 475 call. And that is a call spread, right? $5 call spread. So call spread is bullish. So that in that case, you want the stock to be above 475, right? That will mean that's where you'll reach the maximum profit. So now on the flip side, we could buy the put spread on the same strikes, right? So if we buy the 475 put and sell the 470 put, so now we have a put spread. And in this case, you want the stock to be below 470, right? Because that's where this put spread will reach maximum profit, right? It'll be worth $5. So if we look at this spread, right, No, theoretically, right? Theoretically, that the anywhere the stock lands, right? It'll be worth $5, right? So think of it this way: if the stock goes above 475, let's say, well, this call spread is worth $5, and this put spread will be worthless, right? Because let's say the stock's at 480. So if it's at 480, my call spread is worth $5, my put spread is worth 0. Now let's say the stock is 450, below all the strikes. Well, my call spread is worthless, this 470, 475, but this put spread is worth $5, right? 475, 470 put spread's worth $5. And if it lands in between, let's say right at 472.5, well, the call spread's worth $2.50, and the put spread's worth $2.50. So $5. So no matter where the stock ends up at this point, at expiration, this put spread will be worth $5, the difference between the strikes. Okay, that's the box spread. You could also think of it as you're selling synthetically a 470 versus buying synthetically at 475, or selling at 475 stock, buying it back at 470. Same thing, but let's stick with the spreads. So, all right, so if it's worth $5 at expiration, what would be a good trade? Well, certainly, if you could buy below $5 and it's going to be worth $5 at expiration, that would be considered a good trade, right? Because you're buying it below what you think it'll be worth in the future, right? At expiration, it's worth $5, and if I could buy it for $4, that's a great trade, right? Because then I could just wait and till expiration, and what I paid $4 for, I'll receive $5. So that's one way to look at it. But if there's interest involved, right, I have to pay below what I would have earned an interest somewhere else, right? So if I let's say paid $4.80 for this, right, and at the end I get $5, I made 20 cents. Well, if I could take $4.80 and invest it in a bond and make 40 cents in that same time period, then it's not worth it, right? I'd rather actually sell that spread and invest it somewhere than buy the spread, because I could yield a higher return somewhere else. So that's another thing to consider. But would you want to pay more than $5, right? That's the question. And sometimes yes. That because the idea is, well, then I'd want to sell it above $5, right? Because if it's worth $5 at the end, on the flip side, if it's worth $5 at expiration, well, if I sell it at 5.20 and at expiration is $5, then I just make that extra 20 cents. And sometimes yes, but there's some risk. There's for selling it, because when you sell it, there is a early exercise component, meaning that the other side could break it up. And once it's broken up and you convert one side to a stock, you broke up the box spread. Okay. So in this situation, why I picked this is there is a risk of early exercise because of a dividend, right? And what do we know? That when a stock goes ex-dividend, people who have in-the-money calls can exercise those calls, and if they exercise those calls, they're doing it to convert it to stock to get that dividend. So that's the risk of this. So this spread over here may already be bid. I don't know. I'm going to run it right now. I didn't do the math yet, but could be bid above $5. Let's take a look. So I'm going to run it. So here we go. So it's wide, 475.33, midpoint 502. So certainly in this situation, if you could buy it below $5 seems like a great do, because now you have the option to exercise early for that dividend. So if the stock just keeps going up to 480, you're like, okay, I can exercise my 470 call, get the dividend, and so forth. So that's the benefit of a box if you're long, is you could exercise that in the money call or in the money put, on the other side. But let's stay with the call in this situation. So here we see if we do pay, 533. So if we paid that offer, well, at expiration, if it's worth $5, let's say nothing else happens, you don't exercise the call or nothing, you just let it go to the end. You could see here, no matter where it lands, you lose that 33 cents, right? $33. So no matter where we go, expand it, you can see here, stock goes to 560, 540, 520, doesn't matter where it is. This is what it looks like, right? Goes to 400. It's going to be worth $5. And if you paid $5.33, then you're going to lose that extra 33 cents you paid over. So obviously then it looks like, well, if I sold it for 533, then or over $5, then it would have been a profit almost locked in, but you still have that early exercise component. So you have some risk in there where the stock ends up, right? The stock goes much higher and there's a dividend, you could get it assigned on that call. If it goes much lower and you're short, you could get assigned on that deep in the money put, because now interest rates come into play. So this is what a box spread would look like at expiration, and we talked about the different risks involved in it. So a box spread in general is considered a low risk, as long as you know how to manage it, a low risk strategy, right? So as long as you understand the components of early exercise, it would be considered a low risk. Because without their early exercise, you just basically hold it to expiration. So this is an example of a strategy with 4 legs, right? So now what do? We used 4 legs, calls and puts, 2 different strikes. And what we did was we created a low risk strategy. And what would this strategy really be if we don't consider, without the early exercise component? Let's say we work that out, it would really be an interest rate play, right? If you could buy the box spread for $4.80, for example, if you could buy this box spread, then you're really in control. So if you buy it for $4.80, all you're doing is waiting till expiration to make that extra 20 cents, which would be a pretty good return, right? For a couple days. We're talking about 2 calendar days at this point. So that would be a very good return, right? On yielding 20 cents on 480. If you sold it above there, you got some risk, because let's say you sold it at 533. Well, now you got to get away with not getting assigned. But if you sold it for 533 or 520 and you're able to then close out of it for $5 at expiration, that's a very good return too, right? You didn't even pay for it. You received 520 and then you just bought it back at $5. So that's just another strategy to learn about, because it's a low risk strategy if you know how to manage it, if you understand, when things are at risk of early exercise. And it looks for, you could see here that, this isn't like a volatility play or anything. It's more of, can I earn a yield from now till expiration? And that's one of the benefits of using different legs of options, because you could get creative with your strategies. So, well, I guess if there are no questions, I'm gonna.
We did have one question from Andrew. He was asking I mean, this is a pretty general question, but I'm pretty sure what your answer is going to be, but I'll let you answer it. What is the most consistent income strategy in option according to Market Chameleon analysis or observation? He's asking your analysis or observation, actually, not Market Chameleon.
Yeah. So I think, some people look for, when they say consistent, they're thinking like, something like a CD, where you just do something, and, if you buy a CD, you're going to make 3, 4, or 5%, and then you just roll a CD and you make your 4 or 5%. But, options aren't like that, because they're dynamic. Right? Options are dynamic, markets are dynamic, and things are just constantly changing. So I can't tell you that this do something consistently where always the only thing that's consistent is things are changing, that they're dynamic, and there's really no single strategy that you could say, well, I could do this, and just this reliably will always yield me 10%, per year. Because then, with no kind of risk, or, that kind of stuff doesn't exist. Because
everything is risk, right?
Everything, yeah.
I mean, he got some suggestions from the chameleon community, and one of the suggestions was from Chuck, and he likes selling options, basically. And as long as you are comfortable with the risk, that's a strategy that works for Chuck, right? And there are other people who like, also selling credit spreads, so receiving that premium, but you then identify your risk right from the start, right? So it's depends on your comfort level and what you're looking to do, and what your outlook is, and the time that the options are going to be on the board. So you got to be
yeah, exactly.
Managing the risk is the big deal, and understanding the risk.
Right. Exactly. And because you're trading, you're trading risk assets. As a trader, traders are usually more obsessed with what is the risks that I'm taking? What are all the different risks that I have to this trade, more than just like the return. So how much do I stand to lose? Right. That's always like, as a professional trader, you're always like, how much do I stand to lose? And I feel like sometimes I hear the opposite side, where like, well, how much can I make? How much can I make? And as a trader, we're always thinking, well, how much can I lose? And, what are the different scenarios? Am I getting set up? Does something look too good to be true, and why? And, and where can I lose? What am I not accounting for? So, when, and that's part of risk management. Like, risk management is looking at the potential losses, the expected, the extreme, the maybe something unanticipated. What are all my risks? And that's usually, even going into it, when I even look at, oh, look, okay, this looks like a pretty good, like lining up pretty good. This looks like it's deviated from my from my fair value, it looks like it's, lines up with my, expectations. And so, but let me look through all my risks, and knowing all your risks, like here, you could see how even the Black-Scholes model, right? Black-Scholes model, mostly, right? This is what it deals with. Valuation and risks, breaking down your risks, right? That's what the Black-Scholes. It doesn't say what here's consistent yields, right? That's not what it's the Black-Scholes model, or any models that you're seeing out there, deal with breaking down all the components and all your risks. So here, just here alone, right here, these here are outputs from Black-Scholes: delta, gamma, vega, theta, rho. These are risk components. These are your exposures from this strategy, and knowing your risks and how to evaluate them, how to quantify them, what type of strategies and what kind of exposure is really important, right? Before you jump into anything, you need to know how to evaluate risks in it, because otherwise you can't even manage them, right? So knowing your risks and then how to manage them, it is one of the biggest components of trading, because you're in the business of risk. That's what it is. You're in the business. These aren't CDs, right? We're not scanning for insured certificate deposits. That's not what we're scanning for, right? We're looking at risk assets that these things could lose.
He does follow up. He says, I mean to ask most popular traded strategies being used. I guess that's in the marketplace. Is there any way, I know
So
we track the strategies being used? What the most popular are in the market?
I would say that the just from my analysis, the most popular strategies are vertical spreads. The vertical spreads are the most popular, followed by diagonals and then calendars. So those are, the when I say the most popular, that's the ones I see the most recurrence. Okay. So, you could have a big volume trade that's not like that. I've seen, big volume trades doing, all types of, but vertical spreads, for shorts, which are these are just two vertical spreads that I showed. But the one that, which doesn't mean they're consistently profitable. Those are just where I see
That's what's
a lot
transacted
of,
in the marketplace the most.
yeah, like a lot of, here, let me see if I could do, hold on, let me see.
Is there a spot on the site where you can search to see where those are trading and what different types of spreads are trading?
So not yet. So that's what we're going to be going over. That's what we're going to be going over. This is a preview of what we're going to be going over. This tool's not available. So this tool we're going to be pushing out before our next webinar on with IBKR on January
So
9th.
what you're seeing now is in Dimitri's test.
This is my test mode, but since you
Yeah.
asked, so here's the top 5 in coin. So this is coin. So these are the top 5 spreads. These are all the spreads down here, but these are the top 5 multi-leg trades. So the biggest one yesterday was a ratio put spread, right? 1/2 here. But you could see here, the next one was a call spread in December, 160, 165. Then another call spread, 162, 167. Another call spread. This one traded 58 times for 1,700 contracts. 175, 177, then a put spread. So you could see the top 5 by volume right there, are two-legged spreads. This is a put spread, just a ratio one, right? 1/2. But all these are vertical spreads. So this is just like I gave you one in coin, You know, we could look a couple. Well, we're right up at 9:30, but we'll be talking more about this as we go along.
So as Dimitri mentioned, this is going to be on a webinar, Interactive Brokers. That's I think January 9th, right?
January 9th. This page will also look different. This is my test page. So this is just, you know, right now as we're developing it, you know, this is my test page here. So it'll look different by January 9th, you know. So, but just to give you, because you asked, just clicked on the
No, that's great. And I'm going
to show you guys.
I'm going to put that link in the YouTube chat. So anyone who wants to register for that, you have to register on the Interactive Broker site. And as always, they control these webinars. So even if you can't make it, you can go back and watch it. And actually on their site, they have all of our previous webinars. I think we're in the 30s now with the number of webinars we've done. So
yeah,
you can link to all those webinars. Awesome job, D.
All right, everyone. Thanks for joining. Stay safe out there. Have a great trading day. And I hope to see you tomorrow, right?
We did have one other outstanding question, and I sent it to you, and we'll try to get to it tomorrow. Great job, D. Thanks, everyone.